We are now turning to the Nedgroup Investments Global Equity Fund, a high conviction, benchmark agnostic portfolio managed by Veritas Asset Management. And I've got Mike Moore, portfolio manager on the fund, joining me today. Hi, Mike. How are you?
I'm good, thank you.
Great. Thanks so much for joining us. Mike, I guess just before we look at recent performance of the fund and attribution and portfolio positioning and so on, if you can please just talk us through, let's call it the underlying philosophy behind how you manage the fund and how is it different to, let's call it a typical global equity strategy?
So in terms of how we manage the fund, so we're looking for what we consider to be high quality, advantaged companies with high or improving return on invested capital businesses. What we're looking to find is those businesses that can generate those high returns and then produce cash flow and then reinvest those and compound those over time. And so typically we've got a sort of 5 to 10 year holding period for our investments. We also hold between 25 and 40 companies typically. So we have high conviction in the investments that we look at. And finally, when we're making those investments as well, we're not sort of quality at any price. We think value matters, valuation matters. And sort of free cash flow back valuation is very important. So we look to deploy capital into opportunities where we think we can get a 15% IRR over a 5-year period. And that's an internal rate of return, so effectively a doubling. And we do that sort of consistently over sort of a long period of time. The other key part of the philosophy is that we're very much sort of absolute return focused. And real return focused, and that's a core part of the philosophy that we're looking to produce strong risk-adjusted returns with a sort of downside protection over time.
That's great, Mike. Thanks for that overview. So I guess if you turn to performance now, a little bit of a tough period for the fund recently, and how should investors be thinking about periods like this when you have, let's call it disciplined valuation-based investing with a quality approach, lagging the broader markets?
Yes. So in terms of the sort of the most recent sort of performance period over the last 3 months and 1 year, it has been challenging. So we have sort of underperformed on a 3-month basis with the fund down 11%, with the MSCI World Index only down sort of 3.6%. On a 1-year view, it is more stark in terms of the performance. So the fund is down minus 5.8%, while the MSCI World Index has risen quite sharply by 19%. In terms of the factors affecting that on a 3-month basis, one of the factors has been obviously the current Middle East conflict that has sort of impacted sort of travel and aerospace related stocks where we have significant exposure. We also have asset light business models that have been sort of derated because of perceived AI concerns. Now, with those, we're actually sort of adding into those positions selectively where we see a sort of a dislocation between the reality of the threat and the opportunity. And I think more broadly as well, we've seen sort of quality as a whole derate, which has been sort of a style headwind to the fund at the aggregate level. On a 1-year view, it's kind of an extension of those trends. And the other point that I would make is obviously on a sort of an annualized basis, we had a year ago sort of Liberation Day and the sort of tariff impact. So one of the areas where we haven't had as significant exposure to is in AI semiconductors. And that has seen a significant performance period over the last 12 months, which has driven the overall market. And so we have limited exposure there. We can talk through in detail later some of the kind of reasons why that is the case. But those have been sort of the kind of the key factors in terms of the performance. That's bled into the 3 and 5 year performance numbers. But what I would say is that on a sort of longer term and since inception basis, we've delivered around about 8.2% returns. Whilst this has lagged the MSCI World Index, we are focused on kind of absolute return benchmarks. And so we're slightly lagging the CPI plus 6% target we set ourselves, rolling at 8.4%. Whilst that is disappointing in the near term, what I would say is the portfolio presently has the highest IRR that we have seen since inception versus our kind of wider universe list, which is a good proxy for the wider market. And so that gives us confidence that actually we are seeing a dislocation in sort of quality companies. The other thing that I would mention is that we are seeing a sort of compression in what we consider to be quality valuations. And so that's giving us really once in a decade opportunities to own fantastic franchises like, for example, MasterCard is one that we've sort of added to recently. And we are getting those opportunities coming through.
Mike, thanks very much for that. I think there's quite a few of the themes and points that you've raised, which I would like to delve into a bit later as well. But for now, if we can please just look at, let's say, focusing in on the 3-month and 12-month attribution. So how have you delivered the returns versus the benchmark? And if you look at, like, how do you distinguish between kind of risk and opportunity in these markets? If you can just make a point or two on that as well, please.
Sure. So I think, as I've just sort of alluded to, one of the impacts that we've seen over 3 months has been this kind of derating of sort of AI perceived sort of exposures that we believe in many cases is very much overstated. And so we are seeing opportunity there. Another factor which has impacted is that we don't typically invest in sort of energy sectors because of the commodity nature of prices and being able to predict that. I mean, this previous period has sort of illustrated that. But at the same token, we do have sort of aerospace and travel exposure that has been impacted by sentiment in terms of surrounding the kind of the Middle East conflict. What I would say there, though, is the companies that we have like Safran and Airbus are very resilient to these sort of factors. And that over the kind of the medium term, they have a habit when they face geopolitical issues of actually sort of recovering relatively quickly. So whilst that's a near-term issue, we do think that has been something that is something that will unwind relatively quickly. And then I think just sort of finally, in terms of the healthcare positioning, we have had a near-term regulatory impact from the US government with the health insurers, where they had a sort of a prior rate before they sort of established a final rate of kind of cost pass through for the health insurers, and so that was negatively perceived. Now, since the end of this performance period, the actual final outcome has come through, and it's been more positive than expected. So that has been a slight headwind in that 3-month period. If we move to I think the 12-month attribution, obviously the sort of the big headwind there has been sort of, I'd say, AI semiconductors having very strong performance where we've got relatively limited exposure. We've also been increasing our positions sizes in sort of data assets, in financial technology assets, and in software assets. But we haven't been doing that in a sort of scattergun approach. We've been doing that very diligently with companies where we think there's an asymmetric risk reward around some of the sort of perceived threats. And so that has been a sort of headwind in terms of derating. But we do think that is actually, in terms of the longer term opportunity, we think that is the right thing to do. I think as well, in terms of United Health, that's been sort of the single biggest drag. And so whilst the health insurers have been have had a sort of tricky year, what happened with United Health almost a year ago was that it had actually mispriced its book. Management has changed. We've actually added to the position on the back of that, and internally the actual execution there has improved markedly. They've had, like I say, this minor setback from the regulation, but again, post this period, that's actually improving as well. I think one of the sort of broader themes that has been sort of a headwind for, I think, quality investors has just been a general sort of P-rating in sort of quality companies and defensives over the past sort of several years. And so that's something that has been tricky, but is also offering, I think, on the long term, some very attractive sort of absolute entry points for investors.
Thanks, Mike. And just maybe very quickly on portfolio trades in the past quarter, please. I mean, I know you have a very low turnover approach in general. If you can please share some of those insights.
Sure. So I think in terms of the the trades that we've done. In terms of new purchases, we haven't made any new purchases as such. But what we have done is we've actually increased positions in companies like Aon, MasterCard, LSE Group, where we've perceived, that they've been sort of impacted by sentiment, and actually we believe that is overstated. So in fact, that's an area where we've seen sort of the portfolio weighting at the aggregate level rise. In terms of complete sales, we have but one that is notable and probably does deserve some explanation, and that's Alphabet. We've sold out of that in its entirety. We've held that position for 15 years. So it's really been an exemplar of what we do as investors. And the reason why we've sold out of Google, to go into a little bit more detail, is because a year ago, there were perceived threats about the search business at Google. There were question marks about its AI positioning that to be fair, we didn't believe at the time. And finally, it was subject to a sort of DOJ antitrust sort of trials, which again, that there were question marks about the sustainability of the business as it was. So the actual business had traded on a very low teens multiple and a very attractive multiple. Since then, the antitrust situation has resolved favorably in Google's favor. The AI positioning is pretty clear that they're in the ascendancy there, and the search threats haven't really come through as yet. And so what happened was the share price has literally sort of doubled over the sort of past 12 months. The rating has materially increased, and now when we look at the business, this is a company that's spending a lot of capital on this AI investment, so it's pressurizing free cash flow. 90% of the business is still digital advertising in terms of profits. And so that is something that is hitting the top of the S curve, so is maturing. And some of the sort of threats that have kind of gone to the sort of back of people's minds a little bit are still very much there. So OpenAI has now said that it wants to monetize the consumer market through advertising. It has 800 million monthly users. So that will take it. It might not be as successful as OpenAI thinks it's going to be, but it will have some impact on the incumbents. And so we thought with the IRR compressing and the risk reward changing, that actually now was the right time to actually exit the position. And we've also done that, reducing some of the hyperscaler exposure that we do have, given the high coupling sort of investments that those companies have been making. So I think Alphabet's one just to sort of pick on. The other company that was sold out in its entirety is Bio-Rad. With exposure to sort of bioprocessing. There, it was much more a case of the investment thesis had gone sort of off track, and the management execution had been poorer than we expected, albeit it was effectively founder-led. And so when we were re-examining our healthcare positionings in the sort of last 9 months, we actually have put more into the higher conviction parts of the portfolio and increased the weighting there. And so Bio-Rad is one where we didn't have as high conviction, and so we've used that to actually sort of fund other investments over time. So that's why we've actually sort of exited that in its entirety.
Great, thanks, Mike. And just any quick comments on, let's call it, broader portfolio positioning, please?
Yeah, so in terms of the kind of the broader portfolio positioning, in terms of the top 10 holdings, we have a strong industrial exposure. So I think 4 out of the top 10 positions are industrials, and 3 out of the top 5. So that's, I think, Vinci, Safran, and Canadian Pacific, which is a railroad. The other 2 rounding out the top 5 positions are Amazon and LSE Group. In terms of the regional split, although we don't look at it in this way, we look for just where the opportunities lie. We have reduced the kind of North American weighting to sort of 57%. Another 40% is in sort of, I'd say, the wider European area. And then we have around about 3%, which is cash. Now, given aggregate valuation levels in the market, that's actually a relatively low cash balance typically, given the kind of the extended sort of valuation at the wider market level. But what we would say is there's been a significant bifurcation in opportunities. And so when we are seeing idiosyncratic opportunities and areas where we can deploy capital, MasterCard is an example of that, we will look to do that. And so we are finding sort of individual opportunities. In terms of the sector splits, the largest sector is industrials, which is pretty consistent with what it has been. Closely followed at around 20% of the portfolio with healthcare. The one that I think where we've seen sort of the biggest sort of change in uptick is financials. And really that's driven by financial sort of technology positions, where those we think have been sort of derated unfairly. And so we've increased the exposure to those. And then finally, in terms of sort of information technology, that's more sort of similar in size to industrials, but you're not really seeing it because consumer discretionary has companies like Amazon and Amadeus in those areas. So the actual exposure is sort of slightly larger than it appears at first glance. I think one of the aspect to consider about the portfolio positioning is we do have about a quarter of the portfolio that's exposed to sort of wider travel or aerospace sectors. Now, we do believe that the companies that we have are very resilient and have exhibited in the past the ability to recover from geopolitical shocks very quickly. And we think that will be the case again. So it doesn't change the long-term thesis for us, although obviously in the short term, there is going to be some volatility in some of those sectors.
Thanks, Mike. So I guess just from your insights in terms of market indicators that you look at, like what really are markets saying at the moment and how does it impact on the way you manage the portfolio?
So I think at the moment, the two things that sort of spring to mind is that the kind of the market aggregate valuations are relatively extended. If you look at history, so if you look at kind of the cyclically adjusted PEs, they're at or near sort of 50 sort of year highs. So they're a similar level to 2021 where we saw actually a correction. And they are not too far away from the sort of dot-com sort of boom levels. So we do think that they're actually quite a there's not an awful lot of sort of forgiveness in the aggregate valuations, albeit I think that's different on an individual basis. But I think the level of uncertainty is I think quite significant today. And so when we look at consumer sentiment, the University of Michigan studies, which looks at this monthly in the US, it's that sort of 50-year lows, and it's very much in the sort of bottom first percentile. So that is not showing a particularly strong sort of consumer sort of demand sort of backdrop going forward. Secondly, if you look at sort of the global supply chain sort of stress index, that's at levels now approaching what we saw in 21-22, where there was significant supply chain disruptions and inflation that are coming through. So you've got a lot of uncertainty on the demand side and on the supply side. When we look at the current Iran conflict as well, you've got to consider two things, the quantum and the duration. Now, in terms of the quantum, the IEA have recently said that there's a sort of 12 million sort of barrel per day impact, which is when you consider that the kind of 1970s oil shocks were sort of 5 million barrels per day, that gives you an idea of just how large and how significant a shock this is. Now, whatever happens in terms of sort of reopening straits and how long that takes, or if that happens, it's very unclear, obviously. But what we do know is that the infrastructure has been sort of impacted significantly. So in Qatar, around about 17% of its export LNG capacity has been either severely damaged or destroyed. And that's going to take 3 to 5 years to actually get back online. So this is going to have sort of a longer term impact, even if the kind of the conflict was to stop today. And so when we look at that's not a particularly rosy picture at the aggregate level. Where we are seeing opportunities, though, is actually in quality companies. So if you look at the quality sort of factor, in terms of that, it has derated materially over the last 3 years versus the market, and is offering sort of, I'd say, decade low opportunities to invest in quality. Now, some of that has come through asset-light business models being potentially impacted by AI, but it is a sort of a broader theme. And so we do think there's a lot of opportunity there. And then secondly, if you look at sort of defensives versus sort of technology, the technology sort of weightings in terms of sort of super sectors in the US, the disparity between those and the divergence is the biggest that it's been in sort of 50 years and much wider than it's been in the sort of the dot-com era. Now, some of that you can argue is structural, but the levels that we're seeing now is relatively extreme. And again, is sort of is showing just how sort of depressed some of the defensive and durable sectors have become. And so these are sort of opportunities to deploy capital into strong absolute return investments for very high quality businesses.
Thanks, Mike. I mean, you've mentioned AI a couple of times now during today's presentation, and I mean, it's obviously both an opportunity and a risk, but the question is, what's the implications for the portfolio at this point, please?
So when we've actually gone through this in an awful lot of detail because it's kind of the topic du jour. But I think in terms of the exposure, around 2/3 of the exposure of the fund we believe is AI proof or insulated, and that's companies like Airbus that make planes, or Unilever that do things like sort of mayonnaise, that sort of thing, where we think it's the threat is very low. We haven't got an awful lot of exposure in I would say, the classic AI beneficiaries of the picks and shovels at present, and the reason for that is historically, those sectors have been extremely volatile. So memory has seen a significant step up in sort of share price to those companies, but they are man-made commodities and they are extremely volatile. Secondly, you've got the processor companies like Nvidia that have obviously benefited, significantly. But again, if you look at, say, Amazon this week in their shareholder letter, they're telling you that they've got a sort of 50 billion like-for-like run rate business in chips. And so the customers, Meta, Google, Microsoft, are all looking to kind of compete with be customers, but also compete with the likes of Nvidia. And so we do think that there's a fragility to the kind of the multiples and the pricing in some of those areas. Where we're focusing is really on the kind of the moderate and sort of potential AI impacted stocks, because we do actually believe if we pick those correctly, they have some of the most compelling risk rewards anywhere in the market. And, really we expect the kind of, as they climb a wall of worry and, extol some of the kind of the virtues of their business model, that will come through. And an example of that is LSE Group, where it has been perceived as an AI loser because it has a workflow solutions business that people thought could be disintermediated. That is sub 5% of the business. They also have a significant proprietary data business that we think is actually, when AI is infused with it, will give better insights to customers and actually be able to provide us more pricing power to LSE. And you can buy that today on sort of a 6% free cash flow yield. These are pretty compelling valuations, and we think as the kind of the more nuanced debates come through, that those will actually see an improvement in sentiment. So we think those are some of the most attractive opportunities in the fund.
Thanks, Mike. I mean, you mentioned what attractive opportunities. Just, I guess, before we wrap up for today, any final comments on portfolio positioning, please? And if you can, let's say, bring in some of the hard numbers that you look at as well.
Yeah, so I think if we look at it across the vector of sort of quality, valuation, and growth, what I would say is the fund is very attractively positioned on an absolute basis, which is how we look at it from a return perspective. So on a CFROI basis, that's basically a cash return on investment. It's 20%, which is a very high level. That's actually 3 percentage points higher than the kind of the wider market. In terms of operating margin, it's 23%. That again is very high on an absolute basis, materially higher than the wider market. The companies that we have very strong cash conversion and are conservatively financed, so around 1.2 times net debt to EBITDA. Typically, quality sort of factors, you usually have to pay more for those companies because of those quality attributes. But at present, you're being given an opportunity where that isn't the case. And so the fund today has a sort of trailing free cash flow yield of around 5%. This is materially higher than the wider market. So it's cheaper, with the market being at 3.4%. And in terms of the PEs, that is actually around 18 times. But versus its long-term history over 10 years in terms of its median, that has derated by nearly 30%. So we think on an absolute basis, you are getting a strong sort of opportunity to deploy capital into these quality companies. The final factor is growth. Now you can cut it several ways, but we do think that the businesses we have strong revenue growth, have strong earnings growth, and convert that into cash. So we'll deliver strong free cash flow per share growth. And that's really the bedrock of our sort of return, our IRR sort of focus of fund. And so when we look at it and sort of take a step back, we think we've got a portfolio of high quality or very high quality in absolute terms investments. We think the valuations in an absolute sense are very attractive. And we think the growth opportunity for these companies to actually sort of redeploy those cash flows is actually very high as well. And so we've got these companies that are competitively advantaged, are well managed. And we think, whilst we can't call macro, we do think they're actually extremely well positioned to face whatever is thrown at them over the next sort of 3 to 5 year period.
Thanks, Mike. Sounds like a once-in-a-decade opportunity to me. Thank you so much
Absolutely.
for joining us.
Thank you.